All right, so good evening, class. Tonight we are going to be covering Chapter 11. Chapter 11 specifically focuses on cash flow estimation and risk analysis. We're going to, for the first part of this chapter, we're going to go through kind of the basic rules that you need to know to be able to do cash flow estimation. And then as we get deeper in, we're actually going to do an example where we apply the concepts, and I will do that in Excel. So we'll do a full cash flow kind of forecast together. And then I'll also kind of show you how CCA works, which is basically taxable depreciation in Canada. And then I'm also going to show you what like a replacement analysis might look like for a piece of equipment as well. So we'll continue on. This is high level, everything we're going to cover. These are all of your learning objectives, which we're going to go through. And as always, with these chapters, we always show how you value a firm, because this is important to keep in mind. Always remember that a firm is just the present value of all of its future free cash flows. And just like capital projects as well, right? If we value a firm based on free cash flows, we value its stock based on, the present value of all of its future cash flows, which are its dividends, right? When it comes to projects, we present value all the future cash flows associated to the project as well, right? So we can use that same methodology of valuation. We can apply it to a whole list of areas like we've covered in the chapters. Okay. So step one, when it comes to doing a relevant cash flow analysis for a project, and it's probably the most important, but you have to determine your incremental cash flows. And this one can get a little bit difficult when you're working in a business. So step one, right, you need to identify the company's cash flows with the project, and then you need to take out the company's cash flows without the project, right? So for instance, if we're projecting doing $100 million in revenue, right? And then with the implementation of, say, an expansion into a new market, that is going to result, say, in an additional $20 million. So the new projection would be $120 million. The old projection would be $100 million. The incremental revenue would be, say, $20 million. But as we might know, revenue isn't always cash, right? So when we're evaluating these types of things, we also have to put it on a cash basis. I'm just gonna pull up. Good. Okay. So project cash flows versus accounting income. When we're dealing, say, for capital budgeting purposes, it's always going to be the project's free cash flow, not its accounting net income. That's relevant, right? So a project's free cash flow, therefore, simply is the project's cash flow that can be broken down into a couple different components. So the investment outlay, this is usually your initial cash outflow. So generally speaking, you don't get money for free. If you want to make money, you have to spend money. I'm sure maybe some of us have heard this before, but as the old adage goes, there's usually an initial investment in the project, right? And then as a result of that initial investment, say we invest $20,000, is going to generate operating cash flows, right? So that operating cash flows is going to be basically your inflows minus your outflows, and then you're going to have your net operating cash flows that are being generated by the project, and we usually put this on an after-tax basis. And then we usually have another section, and this is usually the required net operating working capital investment in the project, which we'll talk about. And then lastly, we have the salvage cash flow. And that's when we scrap the project, we sell off all the assets, and then we usually get a couple cash inflows, right? Usually, imagine having a vehicle to the end, right? It's usually worth something, or you go to the scrapyard and you get $1,000 for it. That's still a cash inflow. It's associated with the project. So high level, when we're calculating project free cash flow, these are the four sections you're going to see when we do this calculation. So the cash flow effect of asset purchases and depreciation. Accountants do not show the purchase of fixed assets as a deduction from accounting income, right? So for instance, and this is just a refresher on how amortization works. I have a blue marker here. Where did it go? There it is. So just a refresher on how amortization works, right? If you buy an asset for, I don't know, let's say we buy it for $5 million, right? That's your initial cash outflow. And then we need to amortize it. So say this asset has a 5-year useful life and a salvage value. Well, actually, let's keep it very simple. So we'll do a $6 million cash outflow. We're going to do a salvage value of $1 million, which is what we'll be able to sell the asset for, right? So we subtract the two, and what you get left is $5 million. And this is basically this is the amount that we have to depreciate the asset. If the asset is active, say over 5 years, that's the useful life of the asset. We would divide the 5 million by 5 years, and this would be our amortization. So we would, on our income statement, to match that, using up basically the asset against revenues, right? So we would match $1 million per year in expenses. And finally, 1 million, right? So this would be today, this would be year 1, 2, 3, 4, and 5, okay? So we would basically expense that asset, right, that capital asset that we're holding for 5 years. We would expense, so 1 million, 2 million, 3 million, a total of $5 million. And then at the end we would have, we originally recorded 6, we would have 1 million left over. And then we would basically have a cash inflow at the end for the salvage value of 1 million when we sell the asset. So this is kind of how we do it for accounting purposes, right? But just as a refresher, this is the actual cash outflow, this 6 million. This is when we pay for it, right? And when we're dealing with projects, we're dealing with cash flows, not necessarily accounting net income. For accounting net income, we subtract depreciation, right? Against our net income. But depreciation, these are not actually cash outflows, right? These, we're not actually paying $1 million every year, right? That initial outflow actually happened here at 6 million. So the only real outflows that actually occur here is when we initially buy the asset for $6 million, and then when we sell it at the end for $1 million. All of this is not cash flow related. We only do it for accounting net income purposes. So in the case of this asset, if we're looking at this project, we would only factor in this initial $6 million investment, and then this inflow that we get at the end for $1 million. Okay. Did I cover all this? Yep, looks like it. So, changes in net operating working capital. So this is the difference between the required increase in operating current assets, right, accounts receivable, inventories, and the increase in operating current liabilities, AP, accruals, due to the project. As we've talked about, I believe in the first section, right, so AP and accruals, this is spontaneous financing that your business generates, just as a, as you operate, right? Just naturally, as you grow, your accounts payable levels that you have in your balance sheet, they're just going to increase, right? Because you're bigger, and suppliers are basically going to extend you more credit. That's a form of spontaneous financing, right? But at the same time, your current assets are also going to rise. So with some projects, right, your net operating working capital has to increase more than it would, right? For instance, let me give you an example. Canadian Tire wants to open a new store, right? So if they want to open up that new store, they have to stock that entire store with inventory beforehand. So what they'll have to do is they'll have to make an investment in inventory, which is net operating working capital, and they'll have to do that before even opening the store, right? So that's an example of having to make an investment in net operating working capital as a requirement of actually being able to run the project. So then we also have interest expenses, which are not included in the project cash flow. So if you remember back to net present value, and we do the weighted average cost of capital, we factor in the actual interest rates that we pay on our debt as part of our weighted average cost of capital. We factor this in to our weighted average cost of capital calculation, and then we use that weighted average cost of capital to basically present value, right, all the future cash flows. So the interest expense is already in the calculation, right? And when we want to present value a project, what we're trying to understand is what is the present value to all investors. And always remember that your debt holders are investors just as much as your shareholders are, right? Your debt holders, maybe they don't get paid dividends, but they do get paid interest, right? And you have to pay them interest. and you pay them interest because they give you capital, right? And in that sense alone, they are technically investors, right? So when we do NPV, the idea is to understand, how much this project basically increases the value of the firm today for all investors. That includes debt holders as well. So when we do those cash flows into the future, we don't take off interest. That way, when we get the net present value, it encompasses, the total value to all investors, debt holders, and shareholders as well. And another example too, don't forget, large businesses, yes, they can go get a bank loan, but they can also issue bonds on the open securities exchange, right? So it is just as much as an investor sometimes, as much as anyone who holds a preferred share or even an equity share in a company. And this is from the lens of, finance, right? Okay. So we do not deduct interest expenses when we're doing a project cash flow analysis. Sunk costs. This is probably one of the most interesting discussions. Instead of trying to explain what sunk costs are, I'm going to give you an example. So suppose the Hudson's Bay Company spent $1 million to investigate the sites for a potential new store. So should this cost be included in the new store capital budget decision, right? No, this is a sunk cost, right? Because here's the deal. Regardless of if you open that new store or not, you've already sunk that $1 million, okay? It's already spent, okay? It's in the past now. A bit of a fallacy that usually exists is the idea that, we've invested too much in this project to stop now, right? Or in this case, right, maybe someone that is in the development department might think, oh my goodness, we've already sunk $1 million into basically investigating, the expansion of this location. If we don't build it, it's all for nothing. Well, what if that store loses $10 million in the first 5 years? Then no, you didn't only lose $1 million that, on the actual investigation piece, you then went on to lose more money, right? And the only reason you did that is because you said, we've already spent too much, we can't back out now, right? This is the concept of a sunk cost. When you're already locked into something, when you can't avoid paying it, right? You don't factor it into the project, because regardless of if you are to accept the project or if you are to not accept the project, that money is already gone and you can't do anything about it, right? So at that point in time, you just treat it as a sunk cost and you don't factor it into your project analysis, okay? The $1 million, you've already spent it. It has no bearing on the decision anymore. It's gone. So other examples are marketing or feasibility reports before a decision is made as well. So opportunity costs associated with an asset the firm already owns. And this is another interesting one. It can be a bit of a brain teaser sometimes. So say a new Hudson Bay store costs $54 million for land and construction costs, right? So that's all in buying the land and then constructing a building on top of that land. Okay. But we already own land and it's valued at $5 million. Okay. And this land that we already own can be used to build a store on. It's a good location, right? So when we look at, this project analysis, do we say, okay, this project will only cost $49 million? No. The project, right, maybe the construction costs will be $49 million, but you have to also recognize that by using the land, right, by using this $5 million piece of land for this project, you're giving up the opportunity to sell that land. Because say we bought a different piece of land, right, we could sell this land for $5 million, right? But by using this land in this project, we basically forfeited the opportunity to sell it and generate cash flow, right? So no, the $5 million is an opportunity cost and it should be charged to the new store project, right? We should still value the entire project at $54 million, $49 million in cash outflows, right? But then we've also basically forfeited $5 million in potential land that we could have sold for cash flows, right? So the alternative use for the land is to sell and receive $5 million, but this is lost due to the project. Okay. So expansion projects and replacement projects. So cash flows from an expansion project. So new assets are bought to expand the existing capacity, and they are easy to identify because they are incremental cash flows, right? So for instance, I don't know, say you're in the 3D printing industry, right? And you have 5 3D printers. Well, you already have a really good idea. Say you buy one of these printers for $1 million, and every year the printer generates 5 million revenue. Well, you already know that each printer usually generates about 5 million revenue per year. So you know if you expend another $1 million, you know it's probably going to generate another, say 5 million sales for you. So the incremental cash flow in that year would be about $4 million, right? So in that case, it's pretty easy because it's basically just, hey, we're buying this asset for X dollars. What's the incremental cash flow that this asset's going to generate and provide value to our company, right? Now there's another classification though, and that's cash flows for a replacement project, right? So not adding a new piece of equipment, but say bringing in a piece of equipment to replace an old piece of equipment. Sometimes we see this, say in dated manufacturing plants, right? We're going to bring in a more efficient piece of equipment, right? Or we're going to integrate a higher degree of technology. So in that case, what you have to do is you have to look at what did the old piece of equipment cost, and how much more profitable is the new piece of equipment, right? And you have to determine what is that incremental cash flow, right? The incremental profitability of the new piece of equipment. And that's how you'd value the cash flows. Okay, so timing of cash flows, we also have to consider. So this is a compromise between accuracy and feasibility. If you remember back to chapter 4 when we do analysis of like compound interest and what's your future value, one really good student I had wanted to ask me at the end of the class, this stock basically pays dividends quarterly, right? So why am I using 30 years when I should be doing 30 times 4, 120 periods, right? Because technically it pays every quarter. Well, it's for simplicity, right? Yes, the cash flows don't always happen at the end of the year at December 31st, right? Sometimes they happen during the year. They usually happen throughout the year. But just for we basically sacrifice accuracy so that we can achieve more feasibility, right? It's not feasible to kind of understand exactly when the cash flows are going to come in because there's so many different aspects that come in as, when customers are going to pay us, right? When things are going to get set up. So when it comes to like just simplicity of cash flows, we usually just use a yearly basis because it's much more easy to understand, especially when we're reporting at higher levels. More complicated is not always better. So high level for simplicity, we assume that our cash flows come in at the end of each fiscal period, and that's how we do our calculations. So effects on other parts of the firm, externalities. So for instance, when Apple was considering a second store in the Eaton Center a few years ago, sales at its first store at Yorkdale Shopping Center were factored in, right? Would the reduced sales at the existing store affect the analysis of the new store? Absolutely, right? Because if I'm opening, say, a new store, and it's the same store, right? I already have an Apple store, but now I'm going to open another Apple store in close proximity. Well, it kind of comes down to the competition theory, and I can't quite remember it from economics, but basically what you're doing is you're cutting off any customers that would have come this way with this new store, right? And those customers are now going to go to this new store and they're not going to make it to the old store, right? So this store is going to have less sales as a result of this new store being here because it's going to cannibalize some of those sales, right? So when opening a new store, you also have to consider, is this going to take away from my existing operations, right? And this is what we would call an externality. Externalities can be positive or negative, right? Which we'll talk about in the next slide. So effects on other parts of the firm, say a net cash flow loss per year on other lines would be negative, or say a cost to this project. It's called the cannibalization effect. So externalities that are positive, it's basically, it's if new projects are complements to existing assets, right? So if you're starting a project and it's actually going to say boost sales at another location, that's a compliment. And you'd factor that in because other areas of your business are going to do well. I'd like to give an example of, say, 2 projects that you might have ongoing at the same time. Say you have a mobile app development project, right? And that is ongoing. And then you have a separate project, and it's for, say, user experience research and design, okay? Specifically when it comes to mobile applications. So with this project, you better understand your consumers, what they're looking for, and overall kind of what's going to make them happy. You use the results of this project to make your other project, the app development, better, and you make the final output better, and that's going to generate more cash flows because it's a better user experience, right? So in this case, you would actually factor in, so you do your mobile app development project, and you do the cash flow specific to that one. And then for a user experience research project, you would say, how much better can we make this app? And what is that, incremental cash flows? And that's the cash flows associated with the research project, right? But those two projects working together, they're complementary. Whereas, say there can be negative, right? And that's what we saw with the two Apple stores. And a lot of times we call them substitutes. So for instance, you're in the soft drink market, okay? And you sell energy drinks like Monster or Red Bull or whatnot. But you're also in the sparkling water sector as well. And by entering into the sparkling water sector, basically what you've done is you're selling a cheaper product, and your consumers might start buying sparkling water instead of your more expensive product, which is energy drinks, right? That's what we call a substitute, okay? And it is highly relevant. So I'm about to show you, an example of sometimes what this looks like. And I pulled this from a Business Insider article, which I've linked below. I couldn't find the original source on the original website. It doesn't look like they have it around, but I could still find this image. And I think it is, even though it is a little bit dated, I think it really paints an accurate picture for you, right? So what we have here is 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11. It looks like 11 large companies, right? From Mars to PepsiCo to Coca-Cola, Kellogg's, Nestle. Like, think about all of the brands that you see within here. I guarantee you're probably seeing about 90 to 95% of all the different, say, snack food brands, right? So chip brands, which I believe are on here. Your chocolate bar brands, right? I'm seeing, Coffee Crisp. What else? Under Coca-Cola and PepsiCo, what you're going to see is you're going to see a lot of water brands. You're going to see a lot of soft drink brands as well, right? And you're also going to see energy drink brands too under both, right? So it is highly relevant because say if you look specifically at, Coca-Cola, and then you look specifically at their soft drinks market down here, anytime that they say introduce a new soft drink, right? Or say they introduce a sparkling water somewhere in this area, there's the risk that basically it cannibalizes some of these sales. So they have to also consider how, opening a new strategic business unit somewhere in here may impact the sales of another strategic business unit, right? But again, I just thought this would be a cool thing to add because a lot of people don't realize these large companies, they open a whole bunch of different brands to service a whole bunch of little niches all across the sector, right? It's the same thing as if you buy a Volkswagen versus an Audi versus a Porsche. Many times they're coming out of the same factory and people don't realize it. Volkswagen Group is massive, but they manufacture a whole bunch of individual brands to appeal to individual consumers. Many of the major car brands do it, right? But this is a great example of how it's done. And when you're doing this analysis for your expansion, you have to consider how, expanding into one sector may impact your other sectors, right? Okay. So now we also have environmental externalities. So these are the most common type of negative externality. So government rules and regulations set the minimum amount of environmental protection, but firms often have some flexibility in dealing with the environmental issues over and above this minimum amount, right? So all firms firms' profit ultimately depends on the earth remaining healthy. So there is there's kind of the added piece. So you can either meet the minimum, or if you go above and beyond, right, when it comes to environmental impacts, you can kind of market this so you can appeal specifically to environmentally conscious consumers, right? But at the same time, you're also protecting your future profits as well by basically protecting the earth. So this is another externality that you have to consider. So maybe think about, say, a snow clearing business. And for anyone who maybe isn't in Canada when they're watching this, for Canada we had a very mild winter this year. So if you ran say a snow clearing business, what you would probably notice is you didn't have to clear a lot of snow this year, right? And why we had such a quiet winter, right? There's a lot of impacts, El Nino and whatnot, but there are environmental externalities that we are just a part of and you have very low control over. So that's something that you might consider on a project cash flow, right? Say every 4 years you have an El Nino winter and you have greatly reduced business, well, you might factor that in because that's an environmental externality. And then adjusting for inflation. So the cost of capital used at the discount rate already includes the effect of expected inflation. So correspondingly, the project cash flow should also be adjusted for inflation, right? So if our sales prices are going to increase by 2% every year, we factor that into our sales forecast when we actually execute the forecast. So the sales price and both variable and fixed costs should be made to increase at the expected inflation rate, so that you're not only increasing say you're increasing top line sales by the inflation rate, right? Passing off basically the increases in expenses to your consumers on your sales, right? Okay, so to sum it up, project analysis focuses on expected cash flows, not accounting net income. It uses the depreciation rates allowed by the Canada Revenue Agency, the CRA. Does not deduct interest expense, includes the investment in working capital, ignores sunk costs, and identifies opportunities and externalities as well. All right, so now depreciation for tax purposes. I think we get into a more detailed calculation a little later on, but very, very high level. We have this concept with depreciation, and it's called double declining balance. It's not quite like this. This is straight line depreciation, right? Whereas with double declining balance, we don't say take the whole amount and divide it by a certain number of years. We just keep applying a constant percentage. So it's important to understand how depreciation affects taxes as well. So depreciation and cash flows. Depreciation is not a cash expense, but shields some earnings from taxes, thus indirectly increases cash flows, right? And I believe it's on the next slide. So when we calculate our CCA tax shield, this is just double declining balance depreciation, but for tax purposes, we just go, what is our CCA amount, right? And we just multiply it by our tax rate. So I'll show you here. On the left, you have company A, okay? Company A has 0 depreciation, okay? And on the right, you have company B. Company B has $10,000 in depreciation. So company A's earnings before tax is $20,000, whereas company B's earnings before tax is $10,000. And that's specifically, as a result of depreciation, nothing else changes, okay? So company A pays $6,000 in taxes. That $6,000 in taxes is basically this 30% that you see here. And that 30% is multiplied by the $20,000 in earnings before tax to get $6,000, right? Whereas for company B takes that same 30% tax rate and only has to multiply by $10,000, right? Because their taxable income is lower, and therefore only pays $3,000 in taxes. So company A has a net income of $14,000, whereas company B has a net income of $7,000. So yet company B deducted $10,000 more in expenses. So this, what's the difference here? About $7,000, right? So we deducted $10,000 in expenses, but my net income only dropped by $7,000. That's because I paid $3,000 less in tax because I deducted that depreciation. Okay. So capital cost allowance and asset classes. CRA classifies capital assets into more than 40 asset groups of classes and specifies CCA rates for these classes. Sorry, someone keeps pinging me. I think that they're in the meeting. Admit. View. Admit. Okay, we're good. All right. Sorry about that. Okay, so CRA has 40 different classes, right? And these classes are basically individual rates for individual types of assets. And if you want to view this, you can basically just go to this hyperlink right here, and it will take you to every single asset class for every single type of asset that you can amortize for tax purposes for a business. So for instance, buildings are amortized at 4% depreciation rate. Machinery is amortized at 20%. Vehicles are amortized at 30%, and computer software is amortized at 100%. Usually first year, you just deduct the entire amount, okay? So say for a vehicle, and I can probably just do this on the fly, just for an example for you. So what I'll do is I'll come down to here, I will open up a new sheet, and say you're amortizing a vehicle, right? So we call this our opening UCC, right? This is our undepreciated capital cost is what we call it for tax purposes. And in this case, right, so say we're buying a vehicle for $30,000. So right now our opening UCC is 0 because we haven't bought it yet. But then we're gonna have a little additions column here. And this is where we're gonna house that $30,000. So we buy this vehicle, say for $30,000. And I'm just gonna make these all commas. Okay, that looks good. And say in the previous slide, it said our depreciation rate was 30%. Okay, so our rate is 30%. I'll make this a percentage, and we'll make this 30%. So how this works, and I'll add in one more column to the left, and I'll call this our total base for tax. And I'll wrap text. Okay, so we have a total base of $30,000 that we can now draw our depreciation for tax purposes from, and that's comprised of our opening balance of 0 plus our additions of $30,000. Okay, so this rate of $30,000 to calculate our CCA, our capital cost allowance is what we call it for Canadian taxes. We basically just take this 30% and we multiply it by our tax base. So it just equals this times this. So our basically, and we'll get into half year rule, we'll get into accelerated investment incentive, but very high level, this is how it works. So in the first year, we would be able to deduct $9,000, right? So on that slide, you saw on the previous slide, we deducted, say, $10,000. So say we bought a $30,000 asset. It is a vehicle. Vehicles are depreciated at 30%. How it would work is we would basically get to deduct $9,000 in that first year for tax purposes. And I'll fix my formula. And then at the end of the year, our ending UCC, our ending undepreciated capital cost, would very simply just be the total base and then minus the CCA that we deducted. So I'd have $21,000 left to deduct over future years. So if we just say date, we say this is year 1, and then we say this is year 2, and our opening UCC is the closing UCC of the previous year, right? This all stays the same. So we're not adding on anything else this year. This calculation stays the same. So we have $21,000 to depreciate this year. Our rate stays the same. And then basically to calculate our CCA for year 2, we just take the new base and we multiply it by 30%, right? So we got to deduct $9,000 in year 1, and now we get to deduct $6,300 in year 2. At the end of year 2, we have $14,700 left. So because I've set this up well, this should work. Nope, it did not work well. Okay, that fixes that. We're gonna set all of these equal to 0, and yeah, I think that fixes it. Okay, so that should fix it, and then I should be able to just drag and drop this perpetually. Yep, I can. So as you'll see, this same piece of equipment or this same vehicle, right? You can just keep depreciating it, because, and this is why we call it double declining balance, is because, you know, even at year 10, our CCA keeps getting just smaller and smaller and smaller, because we keep going to 30% multiplied by the new base, and the new base keeps getting smaller, right? So even after 36 years, there's technically still a balance, right? Because now we're just taking 30% of 11 cents to get 3 cents in basically a tax deduction, right? So when it comes to CCA, it can go on for a very long time, right? Because all we're doing is just applying a very consistent percent. And this is basically how we usually do it. And by the end of year 41, we finally will have a cent left, right? Whereas when it comes to this method, which we generally use for accounting purposes, we would just go divided by the useful life, and then this is the straight line method. Okay, so this is what we use for tax purposes, and this should give you a good foundation for the rest of the lecture going forward. I do hope that makes sense. So, okay, and this is, oh, perfect. This is exactly what I just showed you. But there's an example coming up about the half-year rule. Generally speaking, and for anyone that is very familiar with taxes, please don't quote me on this. It's been a while since I did work in the industry, but I believe in 2018, this thing called Accelerated Investment Incentive came effective and took away the half-year rule. But the half-year rule is coming back. And what the half-year rule is basically, you buy an asset in the first year. When did you buy it? Did you buy it 3 months into the year? Did you buy it 9 months into the year? Right? Did you buy it 11 months into the year? Right? Do we prorate the depreciation? How much do we amortize in the first year? For tax purposes, we say, forget it. We're not getting that complex. Just take 50% of what the CCA should be. That's what the half-year rule is. You depreciate by half in the first year of what the full rate would have been. And that is how we would calculate first-year depreciation using the half-year rule. But I'll show you a detailed calculation when we get there. Okay. So asset purchases and dispositions. So this is that net acquisition I showed you. I'll show you a disposal piece later. But basically your net acquisition is usually just your additions minus your disposals. And whatever that balance is left, that's what you can apply to the half-year rule. It applies to any net acquisitions that are over 0. You only depreciate at 50% of the rate as you normally would. So for, say, say you buy a vehicle for $30,000, but then you sell an old vehicle for $10,000, your net acquisition in that case would be $20,000. You wouldn't take 30% of that, you'd only take 15% of that. You'd use the half-year rule, right? Because depreciation is only 50% of the rate in the first year on net acquisitions. Okay. And then lastly, when you get to the very end and say you have to terminate an asset pool. So basically, if you sell an asset, right, and there's an amount left over, in the case of if the amount is negative, so say, you have a negative UCC balance, as we might call it. So this is your UCC balance. Say you sell the asset and for, $10,000, and now you have negative $9,000 here in this UCC balance. It means you over depreciated the asset for tax purposes, and you need to add that back to your income, right? Because you got a deduction that you shouldn't have got, right? Whereas, say you have a positive balance. So say we got rid of the vehicle at, at year 7. Okay, year 7 right here, we get rid of the vehicle, okay? We get nothing for it. It's worth nothing. It just breaks. We can't get insurance on it. It's worth nothing, okay? There's no longer a vehicle in this asset pool, but we still have $2,470 still in that depreciation pool. We don't keep depreciating it. We get to just write off the whole amount because the asset doesn't exist anymore, right? So in that case, that's called a terminal loss for tax purposes. And then when you over depreciate and you have a negative balance in your UCC column here, after the asset's been disposed, that you would add that back to your net income and you'd pay tax on it because you deducted too much for tax purposes and you didn't pay enough tax. Okay. For anyone that wants to be an accountant, you will absolutely deal with this when you get to corporate. Yes, corporate tax in 4th year. I can't remember the exact code, but we have some very talented professors that will be able to run you through exactly how CCA works. But high level, for anyone that doesn't want to be an accountant, this is me bringing you into the world of CCA and showing you how it differs from how we calculate depreciation for accounting purposes. Okay? All right. So here is an illustration, okay? And this is the purchase and sale of assets. So we have assets in class 10. Class 10 is vehicles. And this is going to be at a 30% CCA rate. So one truck of for $30,000 was purchased in April, and two excavators costing $20,000 each were purchased on June 1st, 2020. Fun fact, June 1st is my birthday, so good time to buy an excavator. And then the truck traded for a bulldozer with an additional $12,000 cash. It doesn't tell you this here, but I believe that happens in 2020. And then tax consequences then they want to know what the tax consequences would be on November 1st, 2021, if one excavator sold for $10,000, or if in the case of B, one excavator sold for $22,000. Okay, so I am going to show you how this works in Excel instead of these detailed calculations, which I'm worried you might get a little lost in. So this is what that situation would look like in Excel. Okay, here is our working document. And in this case, so it says in 2018, we buy a truck for $30,000. So this is for vehicles, it's asset class 10. And this is scenario 1, where the proceeds are $10,000. This is what we end up selling it for at the end. Okay. So we have a 30% tax or rate of CCA that we can apply to determine our depreciation. The acquisition is for $30,000. And so we have basically a total of $30,000 that we can depreciate in year 1. Okay. Now, if you remember, we have that thing called the half-year rule, which means that any net acquisitions, and I should really call this, I'll call this net acquisitions, as not to confuse anyone. So in this case, I think that is spelled wrong. So nope, that was definitely spelled right. So in this case, with the net acquisitions, right, we have the $30,000 in net acquisitions. So our total CCA base, right, is going to be the net acquisitions plus the opening UCC. So because of that half-year rule, right, what we do is we're going to only depreciate 50% of our net acquisitions. And if we did have an opening UCC, this would be depreciated at the full rate. So in this case, what we do, and this is a little complicated, but all I'm doing is I'm basically saying, hey, this is my rate, right? I apply the full rate to my opening UCC. So anything that would be here is, we calculate at a full 30%, but my net acquisitions, which is this 30,000 here, yes, we multiply it by 30%, but we also multiply it by 50% because we only take half the rate, okay? And when we do this, we get $4,500, and this is my CCA in my first year, okay? So my ending undepreciated capital cost would be this total CCA base that I have, subtract the $4,500 in CCA that I've deducted this year, and now I have $25,500 left at the end of 2018. So at the end of 2018, I have this. Therefore, at the beginning of 2019, I have the same amount. I have no acquisitions or dispositions in 2019. So therefore, my net acquisitions are 0, and my total CCA base stays at the $25,500, which is the opening. The half-year rule is not applicable here. I'm not going to use it because I don't have any net acquisitions. So I'll show you something. I can actually just delete this out and it has no impact on my calculations because I'm not using it. Okay, but I'll add it back. So in this case, all I'm doing to calculate the CCA is I'm just going this 30% here, multiplying it by the 25% 500 or 25,500 because I can use the full rate, not the half-year rule, because it's not an acquisition during the year. So I get a total CCA deductible of $7,650, and then my ending amount is the $25,500 minus the $7,650. And I get an ending balance of $17,850. I continue on with the exact same calculations, but something interesting happens in 2020. So my opening UCC obviously stays the same, but I acquired two excavators for $20,000 each, right? So that totals $40,000. Okay, so in this case, what happens when I'm calculating my CCA is this amount here gets the full 30%, right, deduction, whereas this $40,000 here only gets half this. It gets 30%, but multiplied by half, 50%, right? So really, I only get to take 15% of this because I acquired it this year. So when I'm calculating my CCA for this year, it's really, so 30% multiplied by this, plus 15% multiplied by my net acquisitions, and that gets me the $11,350, and that's what I can deduct on my current year's taxes. So I go the total base, subtract the CCA, and my ending UCC pool is $46,495. Carry this over to 2021. So I trade in an asset, right? I trade that asset in and I pay $12,000 in cash for it. And in that same year, I dispose of equipment for $10,000, right? Because this is scenario A, okay? So in that period, right, because yes, I paid out cash of $12,000, but I also got cash proceeds when I sold an excavator for $10,000. My net acquisitions is only $2,000. And in this case, what ends up happening is I apply the 15% to this amount, and I apply the full 30% to this amount. And that's what we end up doing here, is full 30% multiplied over here, and then the 15% multiplied by the 2,000 here. And then we get 14,284.50. And this is my CCA for this period. And then so my ending UCC pool will be 34,000 in this case. All right, so it's not too bad when your proceeds, when you have a positive net acquisition balance, but in scenario B, it does get a little more complicated, because in scenario B, what happens is we actually have a net decrease in the assets. So in this case, there's no half-year rule or anything like that, because we're actually, yes, we still paid out the $12,000, but instead of selling the equipment for $10,000, we sold it for $22,000. Now, you're probably looking at this and you're saying, well, why is that $20,000? Why isn't it $22,000? It's because we have a capital gain. So you can't, for CCA purposes, you can't dispose of a piece of equipment for more than what you paid for it. So because we only paid $20,000 for it, we can only take out proceeds of $20,000 out of the pool, okay? The remaining extra, right, so the $22,000 proceeds that we got minus the $20,000 in original cost, we have a $2,000 capital gain. Capital gains are taxed at 50% in Canada, so we only have a $1,000 taxable capital gain. But for CCA purposes, what we do is we basically go the 12,000 acquisitions minus the $20,000, right, in proceeds that we got for selling the excavators. So therefore, our pool, our UCC undepreciated capital cost pool, is going to decrease by $8,000 in this case, right? So our total CCA base, in this case, is going to be $38,495. Because this is negative, there is no half-year rule. We very simply just take 30% of this amount, 30% multiplied by the $38,495. That gets us the 11,548, and our closing UCC balance would then be 26,000. So this is the difference between if we sold the excavator for 10,000 versus if we sold it for 22,000, and also the capital gain. So this capital gain would get factored into our taxes, and we would pay tax on this $1,000. Okay, that is how CCA works. I promise I'll stop bugging you about these calculations, but I hope you at least found it somewhat interesting how our tax system works. You will have to know tax shields though, and I'm going to teach you tax shields when we get later into the actual project cash flow analysis. But high level, this is how we calculate CCA when we are doing a a future cash flow or a cash flow estimation for a project. And I will release this document so that you can kind of go through my calculations and see how it works. I always found I learned best when I could reverse engineer other people's work a lot of times. So I'll release this so that you can work through it and check out the calculations. Everything I just said is the next 5 slides to a T. And yeah. So, and then this is it all broken out between if it was, say, 10,000 versus if the proceeds were $20,000. Okay, so then we have accelerated investment incentive. And this is introduced in 2018 by the federal government. And it was a temporary measure to be gradually phased out starting in 2023 and ending in 2028. So it's already started that that this is getting phased out. But the entire time I was going through my CPA process and the entire time I worked in tax, when I did work for BDO, this was very much active and I almost always used it. I've never done a tax return where I used the half-year rule. I always use the accelerated investment incentive because I started in public accounting January 1st, 2019, if I remember correctly. So back then, what the government did was they released what's called the accelerated incentive or investment incentive. And what that means is that in the first year, right, I described the half year rule and you can deduct 50% of what your CCA would be, the full CCA would be. It's actually the opposite. So now you can deduct the full 100% plus an additional 50%, right? So you can deduct 1.5 times basically what you previously would be able to. So say you were going to amortize a vehicle, right? You buy the vehicle for $30,000. So instead of getting the full 30% deduction in the first year, you would actually get the 30% multiplied by 1.5. You would get a 45% deduction on that vehicle in the first year. And you might think, well, how does that incentivize people, right? How does a big deduction incentivize people? Well, you would still show the straight line, right, for accounting purposes. But for tax purposes, you would get a much higher deduction, and that deduction means you would get back a lot more tax in that first year, right? So if you're going to have a really high net income in year one, you would say, oh, okay, my net income is going to be high. I'm going to have to pay a lot of tax. I'm going to make a bunch of big investments this year because I can deduct a whole bunch of depreciation against it and pay way less tax because of it, right? So that's one strategy, and that's one way the government incentivized businesses to make investments into the economy and to buy assets, because they would pay significantly less tax in the first year because they would get a huge deduction in the first year for it. Now, this is currently being phased out. I can't remember the exact phase-out plan, but it was like a 2-year as they slowed it down, basically. But yes, this is slowly getting phased out and will be fully phased out by 2028. So if anyone here does get their start, you'll see this, but you won't see it to the full effect that I was working with it, and you'll see it gradually removed. Okay. So analysis of an expansion project. So we're going to take the example of Regency Products Corporation, RPC, and it's investing in new assets to increase sales. So don't worry about memorizing all this, okay? We're going to do this in a working document together, but high level, this is where all the information is coming from, okay? We have like $8 million in initial investments by the looks of it. We have economic life 4 years, salvage value 2 mil, CCA class is 30%, class 43. And then we also have a building cost of 12 million, so total investments can be $20 million by the looks of this. And the building is separate, it's a different class of asset. So the $8 million gets amortized at 30%, and the $12 million gets amortized at 4% for tax purposes. And the building has a resale value of 10 mil as well, which is our salvage. So for the project, we're going to have annual unit sales of 20,000 units. The unit price is going to be $3,000. Unit variable cost is going to be $2,100 per unit. So unit sales price is going to increase by 2% per year for inflation, and our variable cost is also going to increase by 2% every year for inflation as well. And then we have annual fixed costs of $8 million. And those are going to increase by 1% per year, not 2. And then net operating working capital, NOWC. Basically, we have to make an investment. We have to have 10% of next year's sales available in net operating working capital, say in inventory, cash, right? But we have to have that stockpiled so that we can support next year's sales, right? Say purchases of inventory, expansion, payroll, all these different things. So we always have to take 10% of the next year's sales, and we have to have that available and invested. That'll be a cash outflow. And then the tax rate will be 30%, and the project's capital cost, probably in this case, the weighted average cost of capital will be 12%. And so this is what it looks like via the book. we get to do it together. Lucky you. So, I am big on interactive learning. So, buckle up. We're going to work through this together. So, here is all the information I told you not to worry about because I copied it down. So, first we're going to calculate the CCA, and it's going to be pretty simple. So, UCC in this case before CCA. So, in this case, I think I kept it extremely simple. And I didn't do like acquisitions or anything like that. I just basically went, okay, here's the building. And the building's initial capital cost is $12 million. I know this is 12,000, but it's just going to be all in millions, just for simplicity. And my CCA in this case, and I just want to double check to make sure they are using the half-year rule here. So they get 240 in CCA. So let's see if they're actually factoring in the half-year rule or not. So to get 240 in CCA, what they're doing is they're going the 12,000 multiplied by the 4%. No, that's 480. So notice how that's double what they recorded in their first year. That's because they're using the half-year rule for their first year. So if I go this, now I multiply it by 50% or 0.5. Now I get their CCA calculation of 240, right? So there's a difference because of the half-year rule. Okay, and then so my opening CCA or UCC, undepreciated capital cost, for 2024 will be my closing for 2023, right? And I can just carry that formula all the way down, to be honest with you. And then this will just be this multiplied by now the full 4%, not half of it, because it's not the year of acquisition anymore. So now this is 470, and it slowly decreases over time. I'm just going to put these in commas. So don't be confused. These are in millions, right? So add 3 zeros over here and add 3 zeros over here. So that's actually like $240,000 right there. But to make it pretty for you, I will take out the zeros. Okay. So this is calculating the CCA on the building, right? And we said we're investing $12,000 into or $12 million into the building. We're also purchasing capital equipment, right? And this capital equipment is getting amortized at 30%, okay? So the initial acquisition is going to be $8 million, which is up here. I'm just going to save myself the headache now and properly format it. And then, so because they're factoring in the half-year rule, so what I have to do is I have to go this $8 million. I have to multiply it by 30%, but then I also have to multiply it by 0.5 because it's the first year, it's the half-year rule. So what I get is 1.12. That doesn't seem right. So 8, 12, 30%. What am I missing here? Oh yeah, no, it is right because the CCA rate's way higher. Sorry, it threw me off for a second. I was like, why is that so much higher than buildings? Right, because the buildings are at 4% and this is at 30%. So the amortization on this is going to be way higher because we get to depreciate faster. But it makes sense. Buildings have a useful life of 20 or 30 years, right? So in the case of a building, you want to depreciate over a much longer period of time, right? Whereas, you know, maximum, a car is usually, you're only using it for 10 to 15 years, 15 if it's a good truck, right? So you want to depreciate at a much faster rate, which is why we use a higher rate of 30%. So we get 1.2 million in deductions in the first year. And then, so we'll carry this down. I'm going to correct the formatting now before I link anything. Good. And then I will just go here, here, here. Good. And then I just calculate my CCA, this multiplied by this. And then drag it down, drag it down. Good. Okay. So here are my tables for the for 2023, 2024, 2025, and 2026 for this project. Okay. So we're gonna be able to deduct, say for equipment, you know, in 2023, $1.2 million, and then for the buildings, $240,000. So now we're gonna move on to our cash flow projection. So in the case of this cash flow, first, we factor in our initial investment, which is K and L. So the referencing on the side, you can always tie it up here to the original numbers, which I recorded, K and L. So we initially invest in year 0, which is today. We invest $12 million in the building, and then we invest $8 million in equipment. So these are cash outflows, right? We're paying out, therefore it is a negative. This is our initial investment. Okay, so we record our initial investment today, which is 2022. Now what we need to do is we need to project basically what is this going to earn. Okay, so above it told us what the unit sold is going to be. So what we'll do is we go up to units sold, and it says $20,000 in unit, or sorry, 20,000 units, but the unit quantity never changes. If we remember back to the problem, only the unit price changes, right? So what we can do is we can always leave this 20,000 units the same. And if you want to see a quick and easy little trick in Excel, this just equals this, and then drag it over. So they're all equal to 20,000, and then the formula just carries, right? So I'm always selling 20,000 units. I'm selling 20,000 units in year 1, year 2, year 3, and year 4. But if I remember above, my sales price for first year is, where is it? Sales price per unit is $3, okay? So that's my first year sales price. And I'll just put a comma. And so what we're calculating here, right, is my sales revenue. It's very simply just your total units sold multiplied by your price, just basic cost accounting, right? So, but the problem here is I know my sales price increases per unit from one period to the next. So what I can do is I just go this multiplied by 1 plus, and what is my rate of increase on, so my units don't increase. But inflation growth of sales. So my sales price increases by 2% every single year. So if I go this multiplied by 1 plus 2%, aka multiplied by 102%, what I get is a sales price of $3 in year 1, and then a sales price of $3.06 in year 2, right? And then I continue that. I need to lock the cell. If I don't lock the cell, it won't work. So if you don't know, if you go FN, F4, it locks the cell for you. So you don't have to do it. What that means is when I drag this to the right, it doesn't change my cell reference. So notice how this cell reference kept changing, this cell reference, but this one stayed the same even though I dragged it to the right. If you lock the cell, you can lock it. So even when you drag, it doesn't change the reference. So what I do is I drag that across. And now what I've done is effectively forecasted what my sales revenue is going to be. So I will have in 2023 sales revenue of $60,000, in 2024 $61,000, 2025 $62,000, and 2026 $63,000. So my variable cost, it was up here. So it was just $2.10 per unit. And I don't think I actually meant to have this filled out. So what I'll do is I'll actually just get rid of this and we'll just do it together. So it was $2.10 per unit. So I just go the number of units multiplied by the $2.10 that I have up here. Good. And then that gets me $42,000. Now I know that my sales price is increasing by, I know that my variable cost per unit is increasing by 2%. So if I wanted to skip the whole increasing the cost per unit by 2% and then multiplying by the 20,000, if the cost increases by 2%, like per unit, the overall cost is going to increase by 2% as well. So what I can do is I can literally just go this 42,000 multiplied by 1 plus this 2% up here. And then I don't want that cell to change when I drag it over. So what I'll do is I'll go FN F4 to lock that cell. And you see the $2 signs now in the cell reference. And then I do that. So now my variable cost increased by 42,000. This should be a negative, I believe, because we are deducting it. So I'll fix that. And I will fix that. Okay. Whoops. Why did that go positive? Oh yeah, I only have to change one. So now, will it alternate? Nope, doesn't alternate. Good. So now as I go across, I've recorded my variable costs increasing at 2% per year. So my total sales revenue and my variable costs both increasing by 2%. Now I do my fixed costs. So it gave me my original fixed costs. This is going to be a negative because it's an outflow. Where is it? Right here, $8,000 is going to be my year one fixed cost. And then if I look around up here, it says my fixed costs are going to grow by 1% every single year instead of 2%. So it's a different inflation rate on my fixed costs. Maybe it's because that's the rate stated in the contract, say for lease expenses and stuff like that. Who knows? But it is, sometimes you do increase different expenses at different rates. Like for instance, like carbon tax, right? What you pay on fuel in Canada, that's going up way more than the inflation rate, right? Because there's also government intervention as well. So what we do is we now go this $8,000 and we multiply it by 1 plus where is it? The 1% increase up here. We lock that 1% using FN F4 on your keyboard. Now I'm lost. There we go. And now it goes up by 80 bucks because that is simply 1%. So we've increased our fixed cost by 1%. We've increased our variable cost by 2%. Okay. And now we have CCA on our building. Luckily, we've already calculated this, right? So this should be pretty easy. So I go up to here, I go to my building. Here is my CCA for the next 4 years. Who wants to learn a really fun Excel shortcut? Me. So what you do, ooh, these aren't negatives. I need to make these negatives if I can. And I won't be able to. You know what? I'll still show you the Excel shortcut. So what you can do is you can go Control C. So what I'll do first is I will paste as values. Honestly, it's probably easier at this point to hand punch it now that I'm doing this. And then I need these to be negatives for my calculation, so I can go this, and then just put it as a negative. Then drag and drop at 240. So now they're all in negatives, which is perfect. And then what I can do is I can just very simply go Control C. Oof, I need to paste as values so the formula doesn't carry. Okay, and then now, because they're all values, I can just Control C and transpose. So if you go over to paste and you select transpose, instead of pasting downwards, like I copied up here and pasting downwards, it pastes across, which is pretty cool. So if you're an Excel geek, there's a cool little trick for you. Okay, and I am going to shorten up the decimal places because they don't matter. And I'm also going to fix the formatting because I'm an accountant. That just drives me nuts. So just hammer the comma. There we go. Good. Alrighty, and now I am not going to do that whole process because if it was like 20 values, it wouldn't have been so bad, but because it's only 4 values, it's probably faster just to hand punch it. So negative 120, 1.2 million, negative 2.04 million, I could just direct reference these actually, which is what I should probably do, teach you good habits. That's what I'll do. So this guy equals negative. This guy equals negative. This guy. And equals negative this guy. There. So there's my CCA for the next couple years or so. For time. We're doing good. Okay, so this is now my operating income before tax. Okay, so when I have my operating income before tax, what I now do is I just take this amount and I multiply it by 30%. Okay, that 30% is from up here as my tax rate. Sorry, that's not that. That's my rate on my equipment. Here's my tax rate at 30% right here. So I'm just simply going that 30% multiplied by my operating income before taxes. I get my tax balance. And I just very simply take the sum. And here is my taxes. Here's my net operating profit after tax, or as we call it, NOPAT, NOPAT. So this is value J. And then what I do is because the CCA is, as I explained over here, just like amortization for accounting income, right? Because my CCA in this case is technically a non-cash expense because I've already back up here in year one, this is when the cash outflow occurred, right? These aren't real cash outflows, right? These are deductions for tax purposes so that I can accurately forecast my taxes, okay? So in this case, right, what I do is I add back the CCA. So I add these together and I add back my CCA because they are non-tax expenses. And what I get at the end is operating cash flows. So this is the total operating cash flow that the project's going to generate. So in 2023, the project generates $7.43 million. In 2024, the project generates 7.949 mil. 2025 generates 7.96 mil. You get the point. So those are just your operating cash flows though, right? Now, if you remember, we always have to build up, 10% of our next year's sales in net operating working capital. Think of it as inventory. We have to buy 10% worth of, our next period's sales worth of inventory. So to project this, all we do is we just basically take 10% of this $60,000 in sales for the next period here. And that means today we have to make an investment of $6,000. So this should be negative. And I'll fix that right now. So we have to make an investment of $6,000, $6,000, $6,000. And then I don't know why I'm getting, oh yeah, because that is not correct. So, and then at the end of this project, if I recall correctly, well, this is just the incremental piece. So it's actually not 6,000 per year. It should be only the incremental amount. So I need to remember how I did this. I believe it was the equals this amount. So next year's sales revenue multiplied by 0.1, right? So this is the total balance we have to have available, but we also have to consider that we've already made an investment, that being $6,000, right? So I'm going to make this negative. And then, so this is basically the amount that we have to have available. So it was that 6 mil, but then I also factor in that I've already made an investment of 6 mil. So, oh, there we go. So my net investment that I have to make for the next year is only 120,000 because I've already invested 6 mil. So in this case, no, I don't have to invest $6.242 million. I actually only have to invest, my formula didn't carry, my apologies. I actually only have to invest, oh, that's why, minus this amount. I actually only have to invest $1.22 million. I'm going to have to do this every single time. Minus this amount. And then, fun thing, in the final year, here's how net operating working capital works. You get back all the net operating working capital because you're done the project, right? So you've been building up this amount into your current assets or whatnot, this excess, then the project's over, right? So you just sell off all your inventory and you don't have to maintain those balances. So in that case, you get it all back. So what you do is you just take the total investment that you made in net operating working capital. What? Equals, oh, that's why, sorry. Muscle memory. Sum. Negative, I forgot to write some. There. So then I get back 6.367 mil. So I'll fix this. Oh, that's what I did. I made those positive and then made the below negative, but I can see how that would have been confusing. All right, so that is fixed. Okay, so now I basically forecasted my investments in my net operating working capital, which is good. And then I also have to factor in my salvage value. So if you remember above, at the end of this, we can sell the building for 10 mil and we can sell the equipment for 2 mil. So because we're going to sell all that at the end of this project, that's $12 million in cash inflows that we're going to get, right? And then, so this will be our total salvage values. And then basically our total net cash flows are going to be as follows. So in year one, as we see up here, or sorry, today, in 2022, we're going to invest $26 million. In year one, we're going to make have 7.312 million in cash inflows, right? and this is just adding these amounts together. In year 2, we're going to have 7.827 million in cash flows. Year 3, we're going to have 7.836 million in cash flows. And then year 4, we're going to have a total of $26 million in cash inflows, because we're factoring in that we're getting back our net operating working capital because we no longer need to maintain it because the project's over. We can just sell it all off. And we're also going to get $12 million for the assets that we're getting rid of because the project's over. Plus, we also get those final year cash flows as well for a total of $26 million. So say it tells us our weighted average cost of capital is 12%, right? And this is directly referenced from above. So our initial investment was that 26 million. So it was the 12 million plus the $8 million, right? But we also had to invest an additional 6 million into the net operating working capital. So our total initial investment is $26 million, as we see here. But the present value of our future cash flows, this is just the net present value formula. So the rate is 12%, which I'm referencing. And then I always reference year 1 to year 4. I never reference year 0 because year 0 is already present value, right? It's this amount right here. Therefore, I don't need to present value it, right? And I don't factor it into the NPV formula. So the present value of my future cash flows is $35,122. And then my investments today equate to $26 million. So therefore, the net present value of my project is $9.122 million. And then my internal rate of return on that is 24%, right? Just highlighting the total amounts. For IRR, you factor in the initial cash outflow today. And then for MIRR, I specify what my reinvestment rate is. In this case, my finance rate and my reinvestment rate will be my weighted average cost of capital. And I just highlight everything like I did with my IRR. And therefore, it's lower because I'm not reinvesting my cash flows at 24%. I'm only reinvesting my cash inflows, these at 12%, which is my weighted average cost of capital. Okay, so that is how you go through and do a full cash flow projection, and then also go through and evaluate the project. When they get into sensitivity analysis, I'm going to show you a cool trick on how you do a data table. And the data table basically says, if this variable fluctuates by 30% positive, 15% positive, doesn't fluctuate, negative 15%, negative 30, what's the impact on my NPV? Basically, would it change whether I'd accept the project? All right, so let's see here. I need to hop back over to my PowerPoint. Okay, so nice and easily, we just went through basically all of this, but we did as a working document instead of me trying to show you how this works on here. And then we went through and we calculated. I did the NPV, IRR, and MIRR, now these may indicate that the project should be accepted, but the final decision cannot be made until the project's risk is evaluated. This also doesn't replace sound decision making, right? You have to factor qualitative factors as well, not just quantitative. So if it's not aligned with your mission vision, maybe you don't accept it, even if you are earning 24%, right? But then this would also be the payback period. I decided to keep it simple. We've already done this in the previous class, but this is what it would be. So an undiscounted payback period for this project over 4 years would be about 3.11 years. And if we did discounted payback on this project, it would be about 3.46 years to pay back the project. All right, so an alternative approach, right? So as opposed to this, where we basically went through and we factored in all of the CCA like we did here. And then after factoring in all of the CCA that we get to deduct, calculating the taxes, and then adding back the CCA, if we didn't want to do any of that, what we could do instead is we could just calculate the cash flows from the operations of the project, which is that first top line that we did. And then at the very end, just basically calculate the tax savings from CCA. So instead of, deducting CCA and then adding it back, we could just do everything else and then figure out the tax later. And that's through one very specific calculation. So that's what this is saying. Alternatively, instead of doing, and this is what we did up top, right, with the sales, alternatively, we could just literally just go cash flows from operating the project plus tax savings from CCA. So what that might look like is a little something like this. This is how we calculate tax shields. So this is the CCA on the building. This is the CCA on the equipment. So, and then this is the total CCA, the total tax deduction we get every single year from 2023 to 2024 to 2025 and 2026. Now that is our 30% tax rate. That's the corporate tax rate. Okay, that's not the specific CCA rate. So that corporate tax rate we use to calculate the tax shield. So in this case, if we get a $1,440 deduction, right, what we can do is we can multiply that deduction by the 30% tax rate. This $432, this is the tax refund that we get because we were able to deduct this amount. So in this case, in 2024, we get $753 back because we got to deduct $2,500 in taxes, right? And then say for 2026, we get $430 back because we were able to deduct the $1,434. So continuing on, if we take the sales revenue for every single year, which we calculated in the previous projection, and then we subtract the variable costs, which we already calculated, and then we subtract the fixed costs, we get the project cash flows before tax, okay? And then if we apply the taxes, right, the 30% to that, we do get the taxes payable, but it's not quite accurate because we're not factoring in that CCA deduction, okay? So this is tax payable excluding the CCA deduction that we've got on the building and equipment, okay? So this would be our project cash flows after tax. But then what we would also do is we would take these project cash flows after tax, the 7,000, the 7,196, and all these, the 7,601. We would put those here, right? So we still have that same $20 million investment. We still have, that bottom line, project cash flows after tax, right? But what we would do is we would basically subtract, or we would basically add on the CCA tax shield. So we would say, okay, in addition to the project cash flows, we're also going to get cash inflows of 432, and this is basically a tax refund we get for deducting the CCA in, say, 2023. In 2024, we're going to get 753 back for deducting CCA. In 2025, we're going to get $564,000 back from taxes for deducting our CCA, and so on, right? That counts as a cash inflow above and beyond what we calculated up here. And then we also do the same net operating capital because there's no tax implications. And then at the end of it, right, we factor in where our salvage value is at $12 million. We end up with a net present value of 9.122 mil. It's the exact same, right? But in this case, instead of doing, if you remember from the Excel, in the Excel, we went through and we deducted CCA, and then we calculated an accurate tax payable, an accurate after tax piece, and then we added back the CCA because it was a non-cash expense. Whereas here, we don't have to do any of that. We just say, this is my operating cash flow. This is the amount I saved because of tax deductions. Here is my net operating working capital, right? Here's what I get back for salvage value. I get the exact same NPV. So if you want to do the detailed tax, or if you want to do it separately on its own line item, you get the same deal. And it breaks it out, and it can make it a lot more simple. Usually when we'd be dealing with clients or whatnot, and we didn't want to get into the detailed CCA, depreciation, all that, we didn't want to get into the weeds. Every time, 9 times out of 10, we're doing this. And then we just do one line for the tax implications, and you don't have to worry about it because this is very intuitive. Whereas once you get into this, not so intuitive, right? Okay. So when we do the present value of the tax shield, what it is it's basically the present value of all of these savings. So instead of like doing it, year 1, year 2, year 3, year 4, instead we present value all of these and we just treat it as a single number, this single present value of 1661. That's the tax shield today. Basically the present value of our future deductions, or the present value of our future tax savings is what it truly is, okay? So in this case, right, we have, CCA 1, 2, 3, 4, right? And then this is our CCA formula. So I can break this out for you. Sorry, this is the present value of our tax shield formula. So when I break this out, I just have to pull out that note here. So what this is, and I know this is like super complicated, but it's not as bad as you think. So when I'm doing a tax shield, what it really is this. You're basically going, so you take your cost, and this is the original cost of, say, the piece of equipment, and then you multiply it by your CCA rate, and then you multiply that by whatever your corporate tax rate is. Close the bracket, and then you divide that by your weighted average cost of capital as a percent, obviously, plus whatever your CCA rate is up here, okay? So when we do that, what this is this is basically our, this is the present value of all of our future tax deductions on the equipment. Okay, so that's part one of calculating a tax shield, okay? Part two is this. Then, if you remember the, what was it? The half year rule, we have to multiply this piece by, sorry, I need to make that bracket a lot bigger. So we need to multiply this piece by the 1 plus 0.5 multiplied by your WACC, okay? And then we divide that by 1 plus your WACC. So when we do this, basically what we're doing is we are adjusting, right? We are adjusting our PV, just the PV for the half year rule, which hits in the first year. Okay. And then, this is a four-stepper, we continue on, we subtract what is our salvage value, I'm going to stack these up, our salvage value, and we multiply that salvage value by the CCA rate. We multiply that by the tax rate, just like we did over there. And we divide that piece by the CCA rate plus our weighted average cost of capital. Okay, and then we take that and we multiply it. This will be very small, but it's just 1 plus, or sorry, 1 divided by the 1 plus the weighted average cost of capital to the power of n. And what that does is, well, I'll break this one down first. So when we do this, this basically just subtracts the present value, or yeah, the present value of the salvage cash flows. Present value of the salvage value of the equipment. All right, and then this brings the lost tax shield back to your 1. So PV lost tax shield. So, in a very easy to understand formula, this is how you calculate the tax shield when you are basically figuring out all in one number. Basically, what is the dollar value today of my tax savings, right? So, yeah, a lot going on here, but basically all this is this, right? This 161 here, right? This 1661, sorry. Basically all in one, like the value today, right? So of the $12 million in investments we make in capital assets, the present value of our tax savings today in today's dollars is 1.661 million. So you can basically walk up to someone and say, yeah, we're spending 20 million in today's dollars, but in today's dollars, we're saving $1.661 million in taxes because of the deductions we'll get from these capital assets, right? And that is what this formula calculates. In a hopefully easy to understand way. All right. So this kind of breaks down what I just showed you, what I wrote on the board, but I figured it was easier if I went through it step by step. All right, so project risk analysis, so measuring standalone risk. A project standalone risk refers to the uncertainty inherent in its cash flows. So in a project analysis, all of the inputs are expected values, not known values, and actual values do vary from expected values. So say when we do a sensitivity analysis, right? Listen, you can do all the work in the world, okay, to try to properly project a cash flow. And I tell you, like I always use this example in my finance and accounting for non-business majors class, right? Especially when we do the budgeting piece. You know, as of January 1st, 2020, every single company had a great budget, right? They had all set up for, or was it? Yeah, it was 2020. They all set up for 2020. Everything was nice and perfect, right? And they said, this is going to be a great year. And then by March, everyone's budget went absolutely out the window when the first lockdown hit and the pandemic struck, right? Because everything changed. Sales were no longer the same, right? If you were selling business clothes, good luck. Everyone only knows you from this piece up. No one knows what kind of pants you're wearing, right? So therefore, the sale of just generally business, like professional, like styles of pants tanked, and the sales of like sweatpants went way up, right? So as much as you may think you know the future of a project and you may think that you can accurately forecast it, believe me, anything can happen and things can change. So it really helps to understand, say my sales fluctuated by negative 20%. What would happen? Would this project still be profitable? Or would it now go into the red and no longer be profitable, right? So what if analysis do help with this? Because they understand what's our barrier, right, for profitability, and at what point are we no longer profitable? Okay. So when we do a sensitivity graph, the analysis starts with like a base case situation. The base case NPV is calculated using the expected or most likely value for each input. And then each variable is changed by several percentage points above and below the expected value with all other variables held constant, and a new NPV is calculated. So this is kind of what it looks like, how you read this graph, right? So if I look at my sales price, this is my sales price variable, okay? So notice how it says deviations from base case. This is if nothing deviated. So all of these, everything at 0% is the base case. It's the base analysis that we did together, and how we got $9.122 million in NPV, right? Now, say for instance, my sales price specifically, everything else stayed the same, but my sales price dropped by 30%, right? I had to cut my prices to get rid of inventory. My new net present value would be $29.5 million on this project. I'd lose $29.5 million on this project over 4 years, okay? What about if, say my costs drop by 30% though? That's good, right? If my costs drop from by 30%, the NPV of this project would go up to $36.6 million, right? But say my costs increase by 30%, I'm now $18 million in the hole. specifically because of my variable costs, right? And we can factor this in, right? So what happens if my year one units, right? So what happens if my average units per year fluctuates? My average unit sales per year fluctuates by positive 30% to negative 30%, right? Interestingly, my unit sales fluctuating has far less of an impact as my sales price fluctuating. My sales price fluctuating has a massive impact, whereas my number of units sold has a much smaller impact to my NPV. I can take a 30% hit to the number of units I sell and only have a loss of $2 million, where if I take a 30% hit to the sales price, I have a loss of $29 million, right? And then same deal with fluctuations in fixed costs. So if we look at this graph basically reflects all of these variables. So this is the sales price, right? And we see how volatile this is, my NPV is. On the left here, we have NPV. On the right, we have the standard deviation, or the deviation from, say, my base case, right? So we see that, sales price leads to the most volatile NPV. So, changes in sales price massively affect the net present value of my project and our future profitability. Whereas, say, a 30% deviation, say my fixed costs go up by 30%, I'm still profitable at $3.9 million, right? So if I go and I look, fixed cost is the green line, see how the slope is very, very small on this green line, and it's super small in my weighted average cost of capital. My weighted average cost of capital fluctuates, this project's pretty much profitable in any circumstance. My fixed costs fluctuate by 30% positive or negative, I'm still profitable, right? But if my sales price fluctuates big time, I'm in trouble. Okay, so it lets me know, okay, if some variables change a little bit, if my projections are off, not a big deal. But I really can't afford to screw up my sales price, and I really can't afford to screw up my variable costs. Everything else probably won't sink me, but those two specific variables, if they change too much, I could be looking at anywhere between a $29 million or an $18 million deficit at 30% fluctuations. And then at the bottom, it also gives you the total range of possible outcomes between negative and positive 30%. So again, high risk, high reward, right? Sales price goes up by 30%. I went from a 9.122 million present value to a 47.72 million present value. So if I can get my sales prices up 30%, I'm rocking and rolling, right? So that's how you read this graph, and this is how you do a sensitivity analysis graph. So NPVs and sensitivity to inputs. The set of NPVs in the sensitivity table is plotted against each input variable, and the slope of each NPV line is measured against the sensitivity of the project. So steeper the slope, the more sensitive the NPV is to a change in the variable. And then we also have tornado diagrams, and basically what it does in a vertical line shows you what are the most volatile pieces, right? And what was the range on it. So, basically the highest volatility was our sales price, and the lowest volatility was our weighted average cost of capital. So it gives you the range of outcomes based on, fluctuation. So say, my NPV, if it goes down by 30% or goes up by 30%, I'm still positive. My overall NPV is positive, right? Whereas if my sales price goes down by 30%, I'm almost at a 30 mil loss. But if it goes up by 30 mil, I'm up at about $47 million positive NPV, right? So it shows me just how much fluctuations in each variable impact the NPV and the profitability of my firm as a whole. Okay, and then the break-even analysis, it's basically a combination of a couple different variables, but it's at what point am I breaking even, at what point is my NPV zero, right? And before my NPV goes negative. So if I'm operating at an NPV of 2.79, at sales price of $2.79 per unit, a variable cost of $2.31 per unit, a negative growth rate of 20.3%, my units drop to 15,000, or my fixed costs are 12,233, or my weighted average cost of capital is 24.4%. Any one of these scenarios is going to produce a NPV of zero. So it's kind of that baseline. If it goes below that, I am no longer profitable, right? But as long as these stay above those lines, I should be good. But it doesn't, if some go up but others go down, it doesn't account for those. That's where we get scenario analysis. So up until this point, we've been only looking at specific situations in isolation, right? What happens if my sales price drops by 30%? Well, but what happens if my sales price drops by 30%, but my variable cost drops by 30%, right? Well, what happens? Well, I'm going to save $18 million, right, on my variable costs, but then on the fluctuation, I might lose, 20 or 30 something million? So my net loss might only be something around $20 million, right? If I see a positive gain, but a loss in another area. So that's where we get into scenario analysis and we start saying, okay, what happens if multiple variables go wrong? But also, what happens if multiple variables go right, in a range of outcomes? So here is, say you plug this into Excel and you say, this is my base case, this is my best case, this is my worst case, right? In the best case, our profitability is 25%. Or sorry, the probability of this happening is 25%. The sales price would be $3.90. That's 30% above average. Our unit sales are 30% above average. Our variable costs are 30% below average. And our growth rate is 30%. So that's to the application of these fields. So if all of these went right, if my sales price went up by 30%, my units were 30% higher than I expected, my costs were 30% lower than I expected, I would have a total net present value of this project of $173 million. That's better than my best base case in my single variable analysis when it came to that, that positive, right? What was it? This amount here. Yeah, my best case was 47 million positive just by changing one variable. But now that I'm changing multiple variables, they compound together, and my best case is now 173 million, right? Across the best case scenarios for this, and this, right? My base case is still 9.122 million because I haven't changed anything. But my worst case, say my sales price is 30% lower than I expect, my unit sales is also 30% lower than I expect, and my variable cost is 30% higher than I expect, I'm losing about $41 million, okay? So, the impacts compound, right? In this case, but what we do see is the negative effects, the gap between here and here, and then, the gap between here and here, the upside is a lot better than the drawbacks, right? So if I take all of my probabilities and I multiply it by the NPVs, what I end up getting is an expected NPV of $37.583 million based on my probabilities of the outcome. So it's just a weighted average of the probabilities. And then standard deviation across all of these, right? So if this was a bell curve, right? My standard deviation is about $81 million. My coefficient of variation is 2.16. And here's the detailed math behind finding the standard deviation of a net present value and the coefficient of variation. So a project's relative risk to an average project, right? So a project's coefficient of variation can be compared to the coefficient of variation for a firm's average project to get the idea of the relative risk. So if you were in my Finance 1 class, we talked about stocks and we talked about risk, right? And we said, okay, over 40 stocks, you've almost eliminated business risk and you are down to market risk, right? So you're no longer worried about your investments really going down. Well, your true definition of risk at that point is that your rate of return is not going to meet your expected rate of return, right? And that risk is defined by your standard deviation from the average, right? So in this case, something with a high standard deviation, right? It means it has a really big range of possible outcomes. If I graph this out, it looks, I need something to wipe off this example. So if I graph this out, it looks a little something like this, right? So if I have two graphs, this is, say, project A, and then this is project B. And this is, say, the range of outcomes, and say this is my NPV. So say the bell curve is this. Wow, that is not good. You can tell it's been a long day. Bell curve is supposed to be even, you can tell. But this is my bell curve for this project, right? Whereas for project B, my bell curve is this, and it's much more spread out. Project A has a much tighter range, whereas project B has a much broader range of potential outcomes, right? So in this case, right, this project technically has a lesser degree of risk because my range of outcomes is smaller, right? Whereas this project has a higher degree of risk because when things go bad, they go really bad. But when things go good, they go really good. So my standard deviation, right? So my, usually it's 3 from the center point, right? But my 3 standard deviations are much bigger than my standard deviations, say, on this project, which would be much small, right? And basically, when we do standard deviation, coefficient of variation, it's, what is kind of the average for the firm, and then we compare that to the projects that we're going to invest in. And then the ones with a very high standard deviation, broader range of outcomes, those projects are more risky. Okay. So problems with scenario analysis, it considers only a few possible outcomes, right? It assumes that the inputs are perfectly correlated. They're not. Some inputs can go good, some inputs can go bad. Funny thing. And you might never expect this, but say the cost of utilities for a gym. I remember I was doing the statements once, and I was looking at it, and I was like, what in the world? Like, why is it that the gym was shut down and utilities, like the expense for utilities was way higher than we budgeted, right? Like we shut down the building. That doesn't make any sense at all. Why is it that when we have no members in our gym, all of a sudden our cost of utilities goes way up in the winter? It didn't make any sense to me, right? And then I sat down, I had a discussion with my associate VP, and he says, well, you never would have guessed this, but in the winter, when you have people, right, in the gym working out, they're putting off heat. And therefore, those people are actually heating the building. And therefore, we don't have to heat the building because they're heating the building. Heck, sometimes, even on a cold morning, they have to turn on the air conditioning to cool off the gym because there's so many people working out in the gym, right? So that actually inherently reduces costs, and you'd never think that, right? So the more members and the more people you have attending the gym, the cheaper your utilities get for heating, especially in the winter, right? So a lot of times, right, if I just go, what's my worst case scenario across the board, and say, oh, my gym memberships go up by 30%, well, your utilities might go down by 10%, right? And favorably go down by 10%, right? Your costs. So it is something to consider. It's not always worst case scenario. Sometimes things do opposites, right? It's hard to predict. So that's one of the weaknesses of scenario analysis. And here is, a flatter distribution, wide range of outcomes for a larger, standalone risk for a much larger, riskier project. So project risk conclusion, a risk analysis using a quantitative measure. Measures generally allow us to say with a fair degree of confidence that compared to an average project, a particular project has more, less, or about the same standalone risk, right? Depending on the range of outcomes, which defines our risk. So standalone risk and corporate risk are usually correlated, while corporate risk and market risk are usually correlated. I don't think they meant to say that. So with a project standalone risk is a good measure of corporate risk in most cases, because all a corporation is it's just a portfolio of projects, right? Because projects are how we execute org strategy, right? So if I'm looking at my corporation's risk, it's usually just the average risk across all my projects, right? And if they're going to be successful. So qualitative factors, in addition to the quantitative project analysis, is important to consider qualitative factors. So those sometimes impossible to quantify. These factors must include when deciding whether to accept or reject potential projects. So a project's risk can be incorporated into capital budgeting by using a risk-adjusted discount rate approach, right? So for more risky projects, we increase our hurdle rate, which is our discount rate, which we talked about in chapter 10. And say, less risky projects where the cash flows are more certain, we might use a lesser hurdle rate, aka a lesser discount rate for assessing the project. This is one of the qualitative factors that would go into how we build our model. So, and then say we're doing a replacement analysis, right? And this, go back to the start. When a firm wants to replace an asset, So relevant cash flows take the form of differences in cash flows between the existing project and the new replacement project, right? So therefore, what is our incremental cash flow? What are we replacing, and how is what value is the replacement bringing over top of the value that the old, say, piece of equipment would have generated, right? So replacement analysis, example, a new machine costs 12 mil, old machine has a current market value of 1 mil, salvage value at the end of year 5 is 2 mil for the old, or for the new machine, and 0 for the old machine. CCA rate 20%, tax rate 30%, project life 5 years. Investment in net operating working capital is 1 mil, and then annual operating cost is 9 mil, cut to 4 mil. So, and then it gives you a weighted average cost of capital of 11.5%. So in this case, right, what it's showing you is your incremental investment outlay in year 1. So what we have to invest 12 mil in a new piece of equipment. We're going to get 1 mil for selling the old piece of equipment, but then we have to invest 1 mil in our net operating working capital, right? So what we get is a total incremental cash flow of 12 mil. Now this is going to go through and do it slide by slide. I figured it's just easier if I do it in Excel. That way we don't have to individually go do this side by side. But anyways, this is what it would look like. You have the total, right, and it reconciles to before. So you have the total here, the $12 million for the new piece of equipment that you're going to spend, right? So this is year 1, and this is the present value. Anything in year 1 is already present valued, so we don't have to present value it, right? So the total present value of our required investments is $12 million, which are the outflows that occur in year 0, right? And then we have to do our operating cash flows. So if we go back to the slide, what we see here is we see there's going to be current annual operating costs of $9 million, right? But there's also going to be less new annual costs of $4 million, right? So the savings in operating costs will be about $5 million, right? So it's going to be our old piece of equipment costs us $9 million. Our new piece of equipment only costs us $4 million. Therefore, because we're spending $5 million less to operate this piece of equipment, we have $5 million in savings, which is going to go to our bottom line, right? Our bottom line is going to be $5 million higher. But, we have to factor in tax as well, right? So the after-tax savings of this will be about 3.5 mil, right? And then that continues on, and then this is going to be year 5. So I'll reopen the Excel since this kind of shows more of a timeline view. And so what this looks like is we have every single year from year 1 to year 5, the $5 million that we're basically, that we would be, this is the $5 million that we're saving, right? Our new piece of equipment is $5 million cheaper to run. Therefore, this is technically an incremental cash increase of $5 million, right? But we're going to pay $1.5 million in taxes on this additional $5 million in income. So our after-tax income is $3.5 million, right? So the total $5 million less tax we pay. So we get $3.5 million per year after tax. The present value of this, right? If I just do a quick NPV calculation and I use the 11.5% weighted average cost of capital, the present value of my incremental cash flows is $12,774,000, okay? And then at the end of it, I also have to remember I get $2 million on my equipment, right? And that's the sale of my equipment. And then I also get a recovery of $1 million on the net operating working capital that I spent at year 1, right? So I get that back. So I get a total of $3 million in year 5 that I get back because the project's over. I present value that today, and it's worth $1.74 million today, right? Based on a quick present value calculation at 5 years at a discount rate of 11.5%, right? Using the PV formula in Excel. So I get a total terminal value of present value of 1.74. And then, listen, I told you about the tax shield. Here's the calculation for the tax shield. Here's how you do it in Excel. It is a very long formula to do in Excel, I will admit, but it is doable, and it's using only these variables here, right? So I can punch this all into Excel, and I can do, oh, don't do that. So what I get when I do that is basically $1.76 million, $66 million in tax savings, right? Because of my investment in this $12 million capital asset. So notice I'm not deducting CCA here and then adding it back like I did in the other problem up here, right? I'm very simply ignoring CCA, just taking what's my incremental income, applying the tax rate and being done with it. That's because at the end of all this, I'm adding on the tax savings, the CCA tax savings, and just the present value of it. And I do that by using this formula up here, right? So the present value of my tax savings is $1.766 million. I put that all together, right? The present value of the tax savings plus the present value of the terminal value of the project, right? The future cash inflows, plus the present value of all my incremental cash flows, right? But I also deduct the present value of the required investment. And when I put all this together, the project is worth $4.281 million, right? So if you remember, as a general rule, if your NPV is above zero, that project provides positive value to the firm, right? And in that case, we accept the project. So it doesn't, now you still have to factor in risk, qualitative factors and whatnot, but in this case, we probably would accept the project because the NPV is positive. And I also, what happened here? Okay, I'm not going to do that ever again. But I also provided this formula here for reference, right? So this is what I'm doing in here, right? It's just the present value of the cash flow or present value of the tax shield calculation. All right, so that gets us through an incremental analysis, right? And it matches up to what the textbook's calculations were, 4.281 mil. So managing through phase decisions, there's also, if you remember from statistics, you can also do decision trees. What decision trees look like are, you know, time zero, right? What am I going to do, right? So in this case, say I'm making a $500 investment. There's a 20% chance I stop, but there's an 80% chance I keep going. And then at time one, you know, I invest another $1,000, right? And at that point, there's a 40% chance I stop and a 60% chance I keep going and spend another 10 grand. And then time two, you know, say I kept going, I spent $10,000. There's a 30% chance that I'm going to keep going and make $18,000 in year three. There's a 40% chance I keep going and make an $8,000 in year three. And then there's a 30% chance I keep going and lose $2,000 in year three, okay? So, and then of course, you know, if I lose in year three, I'm going to stop in year four, but maybe I continue on, right? And then I earn another eight, right? Or I earn 18, 18, 18. So if you remember from statistics, a series of probabilities can be multiplied together. So in this case, there is a 14.4% chance that I go through all of these investments and make 18 plus 18 plus 18, right? For a total present value of $25,000, right? There's a 19% chance, almost 20% chance that I go through all of these investments and make 8,000, 16, 24,000 for a present value of $6,000. There's a 14% chance that I go all the way to time three, lose $2,000 and stop. And if that happens, I have a loss of $10,000. There's a 32% chance I get to after year one, I spend $1,500, I just decide to stop completely, and I only lose a present value of $1,397. And there is a 20% chance I just stop after year zero, I don't invest in anything else, and I only lose $500, right? So if I go the probability of all these outcomes multiplied by the net present value of all the outcomes, and then I add them all together, what I get is basically my weighted average or expected net present value in this project, right? So my net present value, my expected NPV in this project based on the range of outcomes is about $2,758, with the highest range being about $25,000 and the largest loss being 10. So my standard deviation is about $10,000 as well. So that's how we'd use a decision tree analysis, and here's all the different like decision points. So congratulations, that is the chapter. I'm going to show you one last little cool thing that I think might be useful to you, and then we'll call it a night. This will not take long at all. So I was only going to cover this if we had time. So if you ever want to know, like, that graph where the lines and say a 30%, decrease in my weighted average cost of capital, what's the impact, right? Or say a 30% decrease. Let's do a really impactful one. So let's do variable cost, maybe. No, let's do sales price. So if I want to do this, right? So this is what my sales price would be, say at a 30% decrease. This would be my sales price at 30% increase. This would be my sales price only 15% decrease. This would be sales price at 15% increase, right? And then here's my base value of $3. Here is my base NPV if my sales price is $3. So if I wanted to know, instead of individually calculating my NPV for every single one of these scenarios, if I want to know, what my NPV would be at this sales price, this sales price, this sales price, this sales price, all I have to do is use this interesting function in Excel called the data table, right? And these are a little difficult to figure out if no one ever shows you it, but if someone shows you it, it's actually pretty easy. So all you do is you just very simply highlight these, go over to data. What you're going to do is you're going to go what if analysis, you're going to go data table, and then in the column, because we're doing a column approach here, we go up and we say, okay, this is my NPV, right? I need you to change the sales price and then calculate what the NPV will be. So I go up all the way to the top here, and I basically just click on my sales price, which is right here. So what I'm telling this is to basically, change my sales price per unit and calculate the data table. And it does that. And then poof. Here is my range of outcomes. These might look familiar. If my price goes up by 30%, my NPV is 47 mil. My price drops by 30%, my net present value drops to a loss of $29 million, a negative NPV, right? That's how you do a data table, right? To get a range of outcomes based on, the variation of one variable. And you can do that for every single one of these if you want. But out of the respect for your time, I think I'm going to probably put this one away at that point, because I think that's probably enough forecasting for everyone for one night. So I will get out of here. This is the summary, and yeah, just again, thank you for attending the class. And I'm just going to cancel out of this, and then we can move on to a question and answer period.